All right. Hello, everybody. Hope you're doing well. Thanks for coming in. Make sure you say hi as you enter the room. My name's Jeff Gibby. I've got Larry McMillan with us today for a Ticker Talk. As we get started, I just want to let everybody know this is kind of a bit of a more long, hey, Neil, good to see you. It's a bit of a longer form podcast. So if you've seen them before, you know, we're just going to talk. We're going to talk a bit how Larry got involved in trading, kind of his maybe any memorable stories he has and that kind of stuff. It's designed to be a little bit of a longer form session. If that's not what you're looking for, that's fine. We have a lot of other topics on the or a lot of other videos, including ones Larry's done. Larry's going to be speaking again for us at a big conference we're doing at the end of the month, where it's a little bit more analytics. If that's what you're looking at for, just go back onto the channel and you'll be able to find some other videos. For me personally, I love this long form style, the long form format. I learn a lot of stuff that I didn't expect to learn. So, well, as we kind of get started though, I still need to kind of talk a little bit about the legal disclaimer. So I'm going to go ahead and read this out loud. Today's demonstration is designed to instruct you on using Metastock and the accompanying software plugins. It's not a recommendation to buy or sell any securities, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading securities. Metastock, the Traders Forum LLC, and their employees disclaim all liability for investment decisions by investors based on the use of the software, trading strategies, or any information provided in connection with the company. Metastock, Traders Forum LLC, and their employees do not endorse the purchase of a security, nor are they paid for the promotion of a security. No information contained in this presentation should be construed as a solicitation to buy a security. Hello, Ray. Good afternoon. Thanks for joining us. Okay. A couple of things as we keep going. If you're watching this live on the Traders Forum, that's great. If you're watching this on YouTube, I want to invite you to join us at thetradersforum.com. We've got a community that we kicked off last year. It's going pretty fast. We have market chats where you can share ideas, learn about the markets. It's designed to be a community of traders. There's lots of education up there. You can find out more about it at thetradersforum.com. You're also going to want to do this. Larry, we're going to talk a little bit about his experience in the market as we get started, but he's offering a free month of his Option Strategist newsletter. Option Strategist newsletter has been 30 years in publication. It does current stock market analysis. You can get trade recommendations, feature articles, explanation of key concepts, stocks, indexes, ETFs, commodities, all that kind of stuff. Free month. Go ahead and sign up for that at optionstrategist.com/TDI. As you're watching, if you have questions that you want me to ask, go ahead and type them in the chat. We'll do them. And that's what I have to say to open this up. Now, I kind of want to introduce our guest. So let me kind of come in here. I've got actually one of his books right here. It's called, this is McMillan on Options. Another very, very popular book that, this is kind of not the view that I expected. Another very, very popular book that Larry did was Options as a Strategic Investment, which is very much considered one of the main must-reads when it comes to options and trading options and all kind of good stuff. So, Larry, welcome to the room. How are you doing?
Thanks, Jeff. I'm good. A little crazy today. Every day it's a little crazy now.
Yeah. Do you feel like the volatility has been a little bit crazier than normal?
I think so. But it's somewhat typical in the first year of a presidential cycle because people don't really figure out, what's going on exactly. And this one's maybe a little bigger than most. But typically you'll have a peak in volatility somewhere around March, and it'll decline into the summer.
Now, I've got just like your bio here, and so I kind of read through it. I kind of want to just talk to you a little bit about kind of like your history. So you started McMillan Analysis Corporation in 1991. And before you did that, you had your own, before you did that, you ran it, Thompson McKinnon Securities. You're the equity arbitrage department for 10 years, actually.
Right. So that was a prop trading desk. We did a lot of option things. We did risk arbitrage, all and pretty much anything that was happening on the stock and index side of the business. So we didn't trade futures too much. I mean, we traded S&P futures, but not like corn and wheat.
I gotcha. What is trading the first kind of professional endeavor that you've had? Was it? I talked to a lot of people that when we kind of do these sessions, and it was kind of like never the first plan for a lot of people. Like it's something that they kind of stumble into as they're kind of developing and getting ready to do something else. How did you start trading, and was that initially what you set out to do?
Right. Well, when I graduated from college at Purdue, within a year or so, I was drafted. So I spent a couple of years helping out Uncle Sam.
Yeah.
But I was lucky to get stationed because I could program computers. I got stationed at the Pentagon, so I really learned a lot. We were rewriting operating systems that led to a job at Bell Labs. So when I got out of the Army, got out of grad school, got a job at Bell Labs, and it was really there that in that grad school era that I started looking up, started figuring something derivatives. And so it's kind of a funny story. Actually, I was still in those days, the Denver Broncos would sell to the public 4 games and 4 tickets per game. So you could buy a total of 16 tickets, but you had to go down to the stadium and stand in a line and buy tickets. So I was standing in a line that was literally a mile long and a mile high. And it was kind of boring. So there was a bookstore there. I ran in and grabbed some books the title was How to Make a Million. But it was really a book about convertible bond funds, or convertible bonds anyway. And that was my first, contact with derivatives. Like I liked some money in convertible bonds. Started paying a lot of attention with, with next couple of years. I went to Bell Labs in New Jersey, was working there, and started trading for myself at that point because I inherited some money. And I was really got into options right from the very beginning when they were listed sub-3. And so that was, I was just pretty much self-taught. There were any, at that time, about maybe one. It's kind of a pamphlet sort of thing. But that's how I got into trading. I don't know, options just made sense to me. So I was able to, back in those days, the prices were pretty crazy and often wrong. So with the mathematical model, the Black-Scholes model was already public by that time. So I don't think a lot of the floor traders were using it, more or less the guys at Bell Labs were using it. But, so I mean, that's really how I got started trading. And then eventually I got a job at Thompson McKinnon retail department, which then led to me moving over to the chain third. So.
Okay. Very interesting. Do you remember who wrote that initial book? Oh, also, I meant to say thank you for your service. Was that the Vietnam War?
Yes. Well, I got drafted in 16.
All right. So do you remember the author of that How to Make $1 Million book?
Yeah, his name was Mort. I think it's Mort. Schulman's the last name. So it's pretty funny. Later on, when I was, on Wall Street, I met an Arab guy, Payne Weber, who's still a friend of mine. He had read the same book to get interested in derivatives in the first place when he was in the Air Force. So that book got around. I guess the title, How to Make $1 Million, got some.
They may have been selling the dream just a little bit. That was was that back in the 70s? That was probably I don't know. I was looking at some numbers yesterday, just saying how much would a 1980s millionaire be worth at $3 million. So a 70s millionaire, that's probably, I don't know, 5-6 million. I'd have to Google it.
Yeah, well, it doubles every 7 to 14 years, depending on what interest rates are. Fine.
Well, okay. So then you started with bonds. That's interesting. You made the transition over to options. Do you remember did you ever buy, did you start buying stocks, or did you just jump straight into options?
I started out with stocks. I remember the very first thing I did, I actually in the Army. I wanted to just invest some money. So I went down to a local brokerage firm, and it was Thompson McKinnon. And they wanted to buy some environmental stocks. And I had picked out a few. There were even back then, environmental stocks were a thing. And picked out a few, but the broker lady they assigned me to had talked me out of all those and put me in some other ones with. I still have the certificates that basically won't be, worthless. So that worked out so well. But there were no listed options yet. Boy, that was like 1970. And so then I switched brokers and got a guy who was interested in technical analysis. And so we did a lot of study of technical analysis. That's how I really got into that area. So then when options came along a couple of years later, it was already pretty much, trading stocks via technical analysis and not trying to pick out some theme, environmental exercise.
Okay. One of the things that I'm over the years, but I've been doing this a long time, but a lot of people have a very big esteem for you and consider you almost a mentor. Almost everybody's read your book. The question that I have for you is, do you have anybody that you would consider your mentor as you kind of got started?
Right. So in option trading, not really, because I was there right at the beginning. So when I did get to Wall Street, which was not until 76, there were some guys there who had been trading options way back in the old over-the-counter days. And there was one guy at Thompson McKinnon, Clough, who had been around a long time. So, it wasn't like, he had a couple of strategies, and even some today are still years. So he's passed away, unfortunately. But, so I did learn some, I would say, strategies from him. I wouldn't say in theory per se, but there's a strategy that we use called covered rival relative edits, which something he came up with even back in the old counter days. You could still do that sort of. So that would be probably the closest thing. Art also introduced me to a bookie, so I learned a lot about sports betting from this.
Oh, that's fun. Let's see. Let me, I know McMillan analysis, that you do a lot of money management. You're doing a lot of newsletters. You do a lot of research. Is there any particular part of the business that you particularly enjoy?
Well, I kind of like the whole thing, but I do like trading. Trading itself is I think, fun. That's why I don't really plan to retire.
I was going to ask that. Yeah. How do you just feel like you're just going to trade until the very end and keep doing the research and stuff like that?
Yeah. It's, you don't find new things too often, but you do a little bit here on the strategy that we've been using recently based on, selling put credit spreads on stocks that are hard to borrow. And that strategy has been around a lot. Seems to be a little more pronounced nowadays. I don't know, maybe because these really kind of ever since these stocks became popular, they're very hard to borrow these things. And now you've got sometimes these derivative type ETFs that are also very hard to borrow. So when the stock becomes hard to borrow, the puts are too expensive and the calls are too cheap. And therefore, there are things you can do, so. But that's a new strategy. The old basic stuff, I still like to do that too. Just look for breakouts and high volume and high option volume, that sort of thing.
What would you consider your bread and butter strategy? If there was only one more you could use for the next year, which would it be?
Right. Well, the one that I use, the conservative one, is put ratio spreads where we sell, you're buying let's say at the money put, and you're selling two puts farther out of the money, you get a credit for that trade. So if the market goes up, you keep the credit. If it goes down modestly, you can make quite a bit of money because the long put is making money. If it goes down too far, then you've got a problem because you're short two puts and only long one. So, but that strategy is pretty safe most of the time, and there are safeguards you can take, but That's a nice steady strategy, where you can make on the order of 10 to 12% a year without, standing on your head. You can stay out of trouble pretty easily. And if you do get into trouble, then the options get very expensive and you can make it back, fairly quickly.
I'm sure over the years, you've seen like quite a number of traders come into the market, quite a number go out of the market. In your opinion, what is the biggest pitfall traders should avoid if they're entering, let's say, an options market?
Yeah, so the number one mistake I think people make is they buy an option that's too far out of the money. And so even though they're about the stock, let's say they expect the stock to go up, it doesn't go up enough. And so I don't like that. If I'm predicting where the stock is going to go, I'd like to have an option that's going to make money if I was right about my prediction about where the stock was going to go. So I tend to buy slightly in the money options, and then that eliminates that problem. But you do meet the occasional person who bought a whole bunch of out of money calls and then they hit and they made a lot of money. For most people, that doesn't come true. It's like buying a lottery ticket or something. For most people, it doesn't work out. The occasional guy that. So I think that's the number one mistake that people make. They buy an out of the money call too far out of the money.
You like to buy them in the money. Do you typically look for like a couple strikes in the money? It doesn't sound like you're going deep in the money. It looks like.
Yeah, just enough to get the delta on the walk call up to around 60 or maybe 70, where 100 is the max. So yeah, not deep in the money. You don't want to invest so much there that you tie up with a lot of capital in it. You still want some leverage from owning the call.
Do you, I want to ask you in general what your timeframes look like. What general expirations are you looking at?
So most of my trading is short term.
Okay.
3 to 4 weeks. I do have some longer term things. And pretty much what you see in the Option Strategist is what I'm doing. So last year we did have one, we bought an option, had 8 months to go. That's probably one of the longest options I've ever bought in there. But there was the old saying, sell in May, go away. Well, we noticed that if the market makes a new all-time high in May, then that whole sell in May, go away thing is wrong. And the market pretty much goes up for the rest of the year. So that's what happened last year. So we bought an option that expired at the end of the year. We bought that in, I guess, the end of May. So it's really 7 months to go. But that's about the longest term one I've bought in a long time.
Okay, for sure. What do you think about the hype around 0 day to expiration, like same day options?
So we did a webinar on it. I got pretty sophisticated in that webinar. I trade them almost every day.
Okay.
And
you're a fan.
Most of them seller. Like, naked options has never been a worry of mine. I always feel I can control it. Obviously, things happen, but beyond your control. But, but I have created this way of looking at the VIX one-day index at the CBOE about it, and also looking at the true range of the index. So the true range is sort of like realized volatility, and one-day VIX is implied volatility. When they get out of line, they can invert either way. But when they get out of line, then there's a trade, I think. And so far it's been working out.
What are your expectations as we kind of get into this year? You had kind of talked about volatility peaking in March. As we go into this year, and particularly, let's put a time horizon on it. Between now and summer, would you say that you're bullish? Are you bearish? Are you still waiting for the data to come in?
Well, we're in an interesting year right here. So there's an old saying that years that end in 5 are very bullish. And of course, the first one was 1895. That's the Dow was created right before that. So we don't have a whole lot of years ending in 5, but we have one, 2 of them or something. But then the first year of a presidential cycle is often somewhat bullish because they try to, get some new policies going or whatever. The second year is often a problem. Like the last administration, the second year was 2022. That was a bear market. But so this year is very rare in that we have a year ending and it's the first year of the presidential cycle. So we only had 7 of those in the past. In terms of S&P, all 7 have been positive years. The last one, 2005, was not all that great, but everything else before that was a pretty big number on the upside. So there's a long-term trade for it. But unfortunately, I looked at the December 31st options right now, and they're really expensive. I can't justify buying them. They're just, even at the money, they're just too expensive. So even trying to spread them. But anyways, that's one thing. And, as I said, there is a volatility peak in March, but the real volatility moves come later in the year. There's a volatility low around the 1st of July. So you typically want to be a buyer volatility in, say, July and early August. Usually by August, the market is already making some sort of wild move. Last year was down the downside. And then volatility accelerates all the way up to a peak in October. Usually that coincides with the market falling into October, but not always. And then it tapers off again after that. So, that's just a normal year. I expect this one to be maybe a little bit more
crazy.
Extreme on the.
Do you have any expectations as who will be the winners and who will be the losers when it comes to, let's just say, a Trump presidency?
Well, I mean, I don't think they're hiding anything. I think the crypto type of stocks will do very well. So there's a couple of these ETFs where they sell cover calls against basically crypto stocks. One is MicroStrategy, but the ETF is MSTY. Another is Coinbase, and the ETF is CONY. We've been writing articles about these the last few weeks, and they paid big dividends. If you had bought the MicroStrategy ETF when it first came out just over a year ago, the dividends were already have covered your initial purchase price, the entire stock.
That was those two symbols were MSTY and
that's associated with the stock MSTR, MicroStrategy. And the other is CONY, that's associated with Coinbase, COIM. So the underlines are pretty wild and crazy, but the covered writing ones are not so insane because they're selling calls against them. Well, actually, they're selling call credit spreads against them. So we play that in these articles. But so something like that, I think, is certainly in the ballpark. If I don't know, like trying to predict what's happening in energy is always a crazy thing. I remember when President Obama took office, everybody thought, well, the solar stocks will do great. Stock did terrible. So, I mean, that's a hard game to play, something like that. But it does seem to me that, there is going to be some push towards, I won't say legitimized because I think that the cryptos are already legitimate, but there'll just some push towards making them maybe more of a accepted.
Yeah. What do you actually, Ray wants, since we're talking about Bitcoin, and I think this is great, a great question. Thank you, Ray. What do you think about, instead of owning Bitcoin, to own one of the Bitcoin ETFs? Is there things that you should be aware of or concerned about with that?
Yeah, I mean, the ETF market is pretty straightforward. I guess you have to see what they're actually owning and make sure they're owning, Bitcoin or Bitcoin futures and not some other, I know there's like a million of these different crypto currencies, but as long as you're in the ones that own that, then that you should be good. Or even as the ones I just pointed out, they're covered writing ETF on stocks that own a lot of Bitcoin or dependent on Bitcoin.
What obviously gold's making new highs these days. Do you feel like that's a trend that's going to continue, or do you think? I mean, I've always viewed, and you could please correct me if I'm wrong, but I've always viewed gold as more of a safety play. People go into gold if they feel like the market's a little bit shaky.
Yeah, I mean, that's the theory. I've been a gold bull, the long-term bull, for a long, long time. One of the first, I guess, advice letters I ever picked up was back in 1970 of James Dines. And he had, he was one of the original gold bugs. So I don't think he liked fallback. But anyway, he was, gold had just become legal to own again after, I believe, 1969 when Nixon removed the restriction against owning it. And so I bought some, which I actually still have.
Did you tell me where it is and be precise? No, I'm kidding.
I have these, look, back then it was so popular for a while that Merrill Lynch was selling these little 1 ounce gold bar ingots. So I have a couple of those too. That's probably worth more as a collector's item. Actually, it's a gold.
Yeah.
But you're right. So I think in general, the commodities are a good place to look right now. I know we're getting buy signals right now with wheat, and the meats like cattle and hogs, especially cattle. So I think that if as long as the dollar is relatively stable, I think the commodity market is in pretty good shape right now.
Do you think, just in a general statement, there's been a lot of talk of tariffs. Do you think those will be a headwind on the economy, or do you think it will be a neutral effect? Do you see?
Well, I'll give you my actual answer because I'm on that CNBC economic survey. So they asked that exact question, and I basically said I think that it won't harm employment, and it a very minor increase in prices. Because I think in reality, this is all just a big negotiating tool. And I don't know how many actual tariffs will actually be imposed now. Yeah.
I got you. Let's see. I actually wanted to talk to you a little bit about money management. Do you, when you trade other people's money, do you kind of follow the same rules as when you trade your own money? Do you find yourself a little bit more risk averse? This is something that I think for me personally, the reason I'm kind of asking this question is if I'm trading somebody else's money, I am not going to take the same kind of risks. I'm a pretty risk averse trader anyway. I think I would be even more risk averse if I was trading somebody else's money. So is there different rules that you employ or different strategies that you employ if you're trading your money versus somebody else's?
Well, the strategy is the same, but you're right. The one strategy that we use in our managed accounts for the predominant strategy is the put ratio spread one I mentioned earlier. But we do that very conservatively. Our downside break-even point is more than 2 standard deviations away. If I'm doing that just for myself, I'm probably not. My downside break-even point is not that far away. And also, when we're managing other people's money, we adjust much more quickly, trying to avoid any real downside problems if they occur. Like last week when the tariffs were announced, the market fell sharply on Monday morning. It recovered right after. We were already planning to take some defensive action if it hadn't recovered. Whereas for myself, I'd probably just wind it down. That's. But definitely when we're managing other things, we're taking a much more conservative approach because the point is that you can lose opportunity. That's one thing. Losing actual dollars is a whole nother.
For sure, yeah. Do you have over the years that you've been, the decades that you've been trading, do you have any trades that are particularly memorable?
Well, yeah, I mean, I don't know. There's been a few like, I mean, I was trading in the crash of '87, so that's That's memorable.
Yeah, yeah, sure.
That was just completely insane.
For sure. Did it change your trading style going forward? After that?
Yeah, not exactly, because we were doing a lot of arbitrage. The point was the arbitrage just got out of whack, and the trading rooms all over Wall Street were being shut down, and they couldn't take advantage of it. So essentially, the arbitrage that was going on at the time was you should have been able to buy the futures or buy the synthetic, and sell the underlying. Nobody was letting you trade or do any of that stuff time. So, then after that, the computers kind of a limited type of arbitrage. But I've had, a few interesting ones. I mean, even last year, my best trade was I actually happened to be reading a piece of gas. It was about how price of chocolate is going to be going up because of various things, whatever. And I looked at the chart of cocoa, and it was just breaking after the upside. So I bought a few calls, and cocoa, they're kind of expensive, but because it's $1,000 a point move, and cocoa we 80 cents. Oh, very short period of time last year. So my memorable trades are in things like I never hit the video of Netflix or those things. So that it's more in the commodity area, or occasionally an option trade really pays them. Usually it's some minor type stock that you've never really heard of. A couple of years ago, which is Kirkland, but that's not the brand name Costco. There's a company, and the stock broke out, went from like 1 to I'm going to say 30, then back to 1 again. But I didn't write it. This just the one.
Okay, that's good. That's good. I've written them both ways.
Well, that happens.
Let's see. So you've talked a little bit about trading futures, trading stocks, trading stock options. What would you say that you mostly trade?
Mostly trade stock.
Oh,
yeah. So
you have to buy a stock just because you,
occasionally, yeah. So if the options are crazy expensive, then I will buy the stock. And that's how I actually got into this MST wide in the first place. I saw the stock breaking out earlier this year, and I looked at the options that they were really expensive. Turns out that part of the fact was these dividends, but it was also just anticipation, MicroStrategy going up so much and everything. So in that case, I bought the stock to begin with. Sometimes with these really cheap stocks, like a $2 or $3, I buy the stock instead of the option there. Yeah, it's like a $2 stock. Like, why bother buying in the money call for 1? And you might as well buy the stock for 2. So, but so my volume is mostly in stock options. I'd say dollar capital still in naked assets in S&P, either put ratio strategy or some zero ratio strategies.
One of the things that I've heard over the years, and I just want to kind of put this out there to kind of let you kind of talk to it. But one of the things I've heard early on at a trade show was like, well, 85% of options expire worthless. And I'd say that a lot of that is by design, but I think that kind of turns a lot of people off from options trading. I just wanted to know if you had thoughts around that.
Yeah, it's true.
Okay. That sounds like you're
yeah. Of course, we all I went back and looked at it, and typically, there's a lot of in the money. There's a lot of out of the money options. Every exploration. Just take a look at, for example, where you've got some real heavy trading volume, and when after it moves around for let's say 8 months, the options listed for 8 months, there's just a lot of in the money options that are still trailing out there. Same thing is true for a stock or whatever. So I'm not sure how that really started in the first place, but it's not really true. And we did write some articles about it maybe 10 years ago or so. I'd have to dig them out. But by the way, on our website, we do have indexed all of our back articles. So you have to just have to guess what.
And that website is optionstrategist.com, right?
Right.
Okay. I'm going to type that in here just to get it on here. Jack wants to know, do you have any favorite option or go-to option strategies? And we asked about that a little bit, but maybe you could talk about kind of like what your favorite option strategy is.
Right. So, I mean, I said that for long-term investing, IRA type money and everything, we use the ratio spreads. That's the one that I use most of the time. The rest of the time, I would say more often than not, I'm basing my option purchases, my speculative option purchases on put-call ratios. The put-call ratios to me are very good contrary indicators and have been for a long, long time. And Marty's wife invented their use as an indicator back in the 1950s and stuck around since then. I know a lot of people, I think, misinterpret it or have you. We've been fairly successful. We use what's called the weighted put-call ratio. I really only know one or two other people that use the weighted put-call ratio. I'm not sure why. But put-call ratios typically are just calculated with the volume of puts versus the volume of calls. Volume of puts divided by the volume of calls. But in reality, we look at the dollar weight. So how many dollars are being spent on those puts? How many dollars are being spent on those calls? That gives you a much better look at things because, somebody could be buying a whole bunch of out of the money puts for, 50 cents or 20 cents. And it counts as a lot of volume, but not too many dollars. But somebody that's doing that in dollar weighting, that's not that many dollars. You're much more interested in what's happening with the at the money or in the money. So I would say that at least 50% of my speculative option trading is based on put-call ratios. And we have a section in our newsletter on that every week. And we also, we have another publication, more expensive one, called the Daily Strategist. It's in there as well. But, then after that, it's just a bunch of, is the stock breaking out, or is there sometimes heavy option volume as a clue, big increase in implied volatility, those kind of things. Those are clues, but I wouldn't say that's my go-to strategy.
Gotcha. You had talked a little bit about selling a man going away, a little bit about a Christmas rally, a little bit about, the question I have is, how big of a role is seasonality in the trading you're doing?
So we use it a few times a year. We just had a seasonally bullish thing at the end of January. It didn't quite work out this year because the government announced tariffs right in the middle of it. But it's still only lost. It was close. It almost got back to where it started. But so there's a few seasonal periods, as you mentioned, right around Christmas. Really from Thanksgiving through the end of January, there were some good seasonal trades. And after that, they're few and far between, but there's a really good one at the end of October. And there are reasons for it. A lot of mutual funds have their fiscal year ends in October. Why they do. So even in a crazy year like 2008, when the market was just getting mauled in the financial crisis in October, that seasonal period produced a huge snapback gain. And, so at the end of October, the market often has a very strict rise. And we've refined some of the entries into the seasonals and what have you. But, there's whole websites devoted to seasonal trading. So it definitely has some.
Yeah. Jake Bernstein runs one. I think
right.
Trader.com.
Futures trader, I think. Oh, trade futures. Trade futures. I think that's.
I'll have to let him know that I give him a little plug. While we're talking about seasonality, I'm kind of curious, to what, if any, broad market stuff you like to look at when you're doing analysis. For example, do you look at what the Fed's doing, like Fed interest rates? Do you look at what sectors are going up, or do you look at CPI data? Like, is there anything that's important that you kind of keep on your radar?
Right. So the simple answer is no.
Okay.
I became just a complete technical analyst, years ago, and really have never figured out how the market reacts to the fundamental data. Sometimes it reacts well, sometimes not. Good news is bad news, good news is good news. I mean, so to me, all of that works its way out in terms of technical analysis. And so we just have this, that's what I pay attention to. Now, that's not to say that you ignore those other things. For example, tomorrow we've got our employment report, and so the 0-day expiration options are very expensive coming into the ones expiring tomorrow are very expensive, as we close today. So the VIX one day had jumped from it was 8 a couple of days ago. Now it's almost 15. That's a big jump in implied volatility, but it could be justified. I mean, I'm not really sure that. Well, we did have that huge move off CPI a couple of weeks ago, and then a lesser but still somewhat serious move on GDP. So I pay attention when these things are happening as to how they might affect the implied volatility of short-term options, but I'm not using it as a factor into deciding whether I want to buy or sell.
Saki wanted to know, and I think this is a really good question. He wants to know if you think the Magnificent Seven are overvalued.
Well, again, I'd say the simple answer is yes, but for example, this week we had earnings on what just collapsed yesterday. It was hold on, I'm just going to take a look here. So we had, that was, the PTIR was up. I don't know if you consider that one of them, Magnificent Seven, but Google was down, alpha, a lot. And so that's another strategy that we sometimes look at is right before earnings, you can look at what the straddle costs in terms of, that's the put plus the call. And it's turned out in the last couple of weeks that, I think Netflix was surprised on the downside, Google surprised on the downside. So I would say that the indication from that sort of thing in regard to your question is, these are probably overpriced because they react pretty negatively to even the most modest piece of bad news. They'll probably gain that head back after I said that, of course. But, so I'm not really shorting them all and that kind of thing, but I am paying attention on their earnings announcements and buying straddles when it makes sense right in front of their earnings. They're not always cheap, but those have been cheap, and we're going to start following this a little more closely again now because some of these big moves have occurred.
I have another question that just kind of popped in. How many open positions would you say that you have at any given time?
I'd say 20.
20? Is that a hard cap, or is that just it can fluctuate with market conditions?
Yeah, it can fluctuate. So typically, if I'm speculating, I try to keep my option purchase to 3% or less of my capital or my speculative capital. The nature puts, of course, that's taking up a lot more capital, but that can be in the form of T-bill. So that's a different account treated a different way. But as far as just speculative positions, so if I'm in 20 positions, that means I'm 60% invested in, pretty risky stuff. That's about, it's again, not a hard cap, but that's about all I really.
For sure. Yeah. That makes sense. Do you have any specific stop strategies that you implement if something's sliding against you?
Yeah, so a couple of things. Well, for just a straight out, you said stop, right? Yeah, so just a straight out, I like to use a chandelier stop. Actually, that was introduced to me by John Bollinger years ago. But it hugs a fastly rising stock pretty carefully, pretty closely, without getting you stopped out on the first little blip downward. So I'm a big proponent of trailing stops. I have no idea what the target for any move would be. And I think it's ridiculous that these fundamental analysts all over Wall Street have these targets, which mean nothing because if it hits the target, then just waste. So it's like completely useless. But if you have a trailing stop and you adhere to it, then you can stick with a long-term uptrend. And, I also am a big proponent of rolling it in an option to be an at-the-money option. I realize that takes a little bit of the juice out of the move if it keeps going, but you still are participating in the move to do that. And also you take a credit every time you do it. So let's just say the stock starts to take off, you roll the option up a couple of times, take out a couple of credits, and all of a sudden bad earnings come out and the stock drops and the last option you're in expires worthless. You still make money overall on the three pieces of the trade. Whereas if you just never adjusted, you could get really hurt on the last, let's say bad earnings. So that's why my big thing is trailing stops and roll your in the money. So that's the way I try to fix it.
I like that a lot. So you don't ever have a target most of the time exiting by either roll out or stopping out?
Yeah, because I don't know where the shares are going to stop out or top out or whatever, but I'm just letting the profits run. They always say, cut your losses and let your profits run, but it's really hard to do. It's not so hard to do if you have an option. I mean, your losses are already limited, and then just let it run. Just keep rolling it up. And I see these people say, "Oh, if your option price triples, then get out." Well, what is that? How did that work for you in the end or something? That's just crazy. So that
do you feel like options are a good investment vehicle for somebody that would consider themselves a novice?
Yeah, I do, because for the one thing I just said, it automatically limits your losses. So you can tell right away going in, you can control what percentage of your account could possibly be lost in this trade. A lot of times people have no idea in the stock trade, how that's going to really work out. So I think in that regard, it's very good. And then, of course, there's the ability to adjust as you're going higher. So you keep your reducing risk capabilities of the option. Keep that in place as the stock is going high. So most people, I don't think, probably adhere to that stuff, but they should. And it's really, I think options are still, after how many, we've been trading for 50-some years now, they're still not really all that well understood. Oh, it's a shame, but I try and do my part.
Yeah. What do you think is so in news traders kind of tend to wash out at a pretty high clip. What do you think is the biggest pitfalls new traders fall into? And how would you recommend that they kind of avoid those if they're coming into the market? Right.
Were you talking about any particular kind of traders? You're just a day trader or just traders in general?
Just traders in general.
Yeah, well, I think lack of discipline is the number one thing. But if you need to have some sort of entry system that makes some sense, put call ratios, stocks breaking out to new highs. I know Greg Morris, I know you've read it.
Yeah, that's
saying, he said they have a nice list of where all the momentum stocks are every day. It's called the new highs list.
Sure.
So now it's talking about the new highs. Let's break it out. Maybe you want to jump on board. So can you go for a while? So that sort of thing. rather than just randomly thinking, oh, this stock would go, or this, I think you need to have some sort of consistency of selecting the stocks, selecting the trades, and that has to have some sort of a check behind it. Not a perfect one or anything, but just, more winners than losers. Like something simple like that.
More gains than losses.
Yeah.
Let's see, what do you do when you're not working? Like, what kind of hobbies do you have?
Well, I am a gambler, I guess. I do play the World Series of Poker. This last summer, I placed in a 5,000 player event. And I also
Can I ask that?
I'm sorry, it was Texas Hold'em.
Okay.
It's what they call deep stack tournament. I came in, I think, 247 out of 5,200.
Not bad. Yeah, not bad. I loved, they used to televise it. My wife and I would watch. This is probably the only sport I've ever watched.
Right. Well, the inventing of the little camera changed that whole thing as far as television. But,
yeah, for sure.
But I do a fair amount of sports gambling too. But now that it's legal in most states, there's data available you can analyze. It's not quite like option game, but it is data, and you can tell where the money's.
All right.
So follow the money. But I play the piano.
Oh, okay.
Enjoy it.
Nice. Do you feel like there's anything that you do as part of your daily routine that helps you? Not necessarily this trading related, but like go to the gym or, is there things that you do to kind of help you prepare mentally to stay disciplined about your trading?
Yeah. I don't know. I think maybe back when I was running the prop desk on Wall Street, that was more important. Really did go to the gym every day.
Mm-hmm.
Now I don't.
Sure.
Yeah, I think when you're young, really, we were running 600 million trading like 10 times as a member. That was pretty a champ.
Okay.
But I'm not trading anywhere near lovers with us. So now it's more like have I got my morning coffee?
I think that's what I have. Let's see. I don't have anything more. Let's see. Let me just check here. Yeah. This was great. All right. I appreciate you coming in and spending some time with us and kind of being part of the podcast.
Yeah, appreciate it. So I'm doing a webinar this weekend, sort of a forecast webinar, talking a few more of the things like this, the fifth year, the first year of the presidential cycle, that sort of stuff.
Okay. Do you happen to know how people can find out about that?
So if you go to our website, I think it's under events.
Okay.
Right across the top there's a bell saying look at stuff that I'm sure it will be recorded as well.
And that website is optionstrategist.com. Just click on the events link.
Yeah.
And make sure you do this because you should do this. But let me go ahead and click this up to the screen again and sign up for a free month. Optionstrategist.com/TDI. There was a comment earlier, Jack Rector, or Jack R, says he's a subscriber to the Option Strategist newsletter, and it's an excellent service, by the way. So, Ray, you can just try it for free. Optionstrategist.com/TDI. All right. Well, is that the only newsletter you do, or are there a few of them?
I'm just going to mention one thing. Just actually a question. How many option exchanges are there in the United States?
I thought it was just Oprah.
It's 19.
Oh my goodness. Oh, okay.
Most of them are trading, payment for orders.
Okay.
And that's equity and stock options. The index option market is completely dominant CBOE because they have exclusive rights to the S&P products, just includes the Dow. So no one else is busting in on that too much. But, yeah, not as account SPY, because SPY's each of it.
Right. Okay. Yeah. Well, Saki says, excellent session. Thank you for joining us. It's really good to have you, Larry.
Thanks,
I appreciate everything. So thanks for being here.
the next Metastack one.
Yeah, it's coming right up. We're going to be doing one here the last week of February, and I have you on Tuesday, I think, if I'm not mistaken, maybe Monday. Yeah.
Okay.
Cool. Thank you very much. Good to have you.
Go see it.
All right. optionstrategist.com/TDI. Again, if you enjoyed the session, it helps a great deal. If you like and subscribe, if you're watching this on YouTube, make sure to like and subscribe. We do sessions like this all the time. And I'll see you at the next one. Thanks again, Larry. Thanks, everybody. See you again soon. Have a good night.